Hey guys, so I've been talking about adding to my house builder stocks for a little while now, and I wanted to just sort of do a little bit more of a look into them to see if sort of we're burying our head in the sand a little over the housing market, sort of US and UK really. Still getting a lot of sort of bullish analyst estimates from Taylor Wimpey, Barrett, and Lennar. Um, Although the share price is sort of down tremendously, these earnings estimates haven't been adjusted down. So Taylor Wimpey, they're still on Yahoo. 17 analysts showing 19.15p, um, up from 18p last year, and sort of projecting 20.34p for 2023, and sort of projecting 4.8% growth over the next 5 years. I always think these next 5 years figures are a little bit unrealistic. Some of them come up with some very, very odd figures, but yeah, that's sort of the earnings projection. So it gives you a forward PE of sort of 5 or 6. Their net cash, both them and Barrett Developments are both net cash. So yeah, enterprise value over sort of net profit, if you like, projected is still sort of about 5 or so. Barrett is pretty much the same, although they're predicting slightly worse year next year than this year, but significantly up from last year. Lennar actually sort of the most bullish on. They're sort of same number of analysts, but $16 earnings projected for this year, up from 14.27 last year, and going up to 17.28. And again, sort of pinch of salt, but the next 5 years, 23%, 23.7% annual earnings increase, which I think is a little bit far fetched, possibly. But yeah, so this gives you a sort of forward PE of about 4, but they're not net cash like the UK guys. They've got a little bit of debt. So yeah, the sort of enterprise value over projected earnings is still sort of about 5 or so. So could say they are sort of priced to fall essentially. If we are going to have a bit of a drop in the market, could potentially see sort of either a drop to coincide with the drop in earnings and they all stay at a 5 PE, or maybe sort of as it happens, people then think, well, now it's over and maybe we'll give them a 6 or 7 PE and the price doesn't actually come down all that much. But yeah, I thought we would look at some facts and figures. So this is UK house prices in the last 50 years, but this is up to 2016. But just to give you sort of a longer term view of how previous crashes have gone. But you'd use the word crash very lightly, really looking at this. So in nominal terms, it doesn't actually come down all that much. You look at sort of the 70s, you had a bit of a stagnation. The 80s sort of had a little bit of stagnation after a rise. The sort of mid 90s, you had a little bit of stagnation, and then sort of a tremendous run up all the way to. So in between there was sort of the .com stock crash, and then the 2007 credit crunch and housing bubble. But again, sort of in nominal terms, not all that much of a drop. And then sort of obviously the QE that followed, money printing, has sort of driven us up to where we are now. Obviously it's gone further than that since. I think we're over sort of 300,000 by various, depends on which index you take and which sort of survey you take. Some of them have different prices, but yeah, we've gone a little bit sort of above that since then. But if you come to housepricecrash.co.uk, admittedly horrible sort of name for a website, but there you go. You can get the inflation adjusted house prices, and this sort of for the last 50 years again. but this does actually go up to Q1 of 2022, so it's a little bit more helpful. And yeah, so those periods of stagnation, often there was sort of fairly high inflation. So in sort of real terms, you do actually see a fair bit more of a drop, sort of in the early 80s and sort of the mid 70s, and then yeah, certainly in the sort of 90s, you got a fairly big drop in sort of real terms. So if the house builders' earnings would be flat, sort of on nominal flat prices, then people don't really want that. They want the earnings to be going up with inflation. You wouldn't want sort of 7 or 8 years of flat earnings, so you'd expect the stocks to sort of not do too well over that time. Then obviously sort of the 2000s we had a huge run up. Even in the sort of, so the dot-com crash obviously wasn't particularly high inflation, so you didn't see a drop there even in real terms. And then sort of the rise up to sort of 2007 bubble, then it did come down a little bit more than it was showing sort of on the nominal chart, including inflation, but not all that much really. And I think this is what sort of leads a lot of people to say that house prices never really come down. I expect if you ask your parents, they'll sort of have more of this in mind and just sort of think they never go down, but not really adjusting for inflation. So if you think about the sort of the stock side of it, then you do want to be including for that. So, but we're not at sort of incredibly high levels. They've sort of done a red trend line all the way through here, sort of including for inflation over the whole period, and we're still above that, below that. Sorry. So yeah, not to say, not saying it's going to rocket up above that, but maybe this doesn't indicate sort of a giant crash. So just some interesting UK figures. You've got the first-time buyer price to earnings ratio. So this is sort of the average UK house price from Nationwide divided by sort of average gross salaries for the UK. So this sort of broadly follows UK house prices really. So when they come down, earnings are sort of trickling up a little more steadily than the house prices. So yeah, you get spikes up to sort of 4 times in the late 80s, and then sort of spike up to 5.5 nearly in the sort of housing bubble in 2007, and we are up to that pretty much at the moment. So this is going up to Q3 of 2021, so that includes some of the pandemic sort of issues with jobs and sort of furlough and that sort of thing. So yeah, it's sort of leveled off there. Not sure I'd really trust this sort of very recent data, but it's about sort of 5 or so. So yeah, maybe a little bit of affordability issues. You've got sort of split down by region. So obviously London is a lot more, but you're not expecting sort of all of this to be local London-born people. It's sort of outsiders and people buying them as investments and that sort of thing. And then yeah, you come down to sort of the north is more sort of in the 4s, which is fairly sustainable, and then sort of Wales and Scotland, Northern Ireland are all sort of in a more sustainable level. So the national average does get distorted by London a little, and yeah, sort of 4 times earnings, maybe sort of up to 5 times earnings. Doesn't seem quite so bad, as I say. Sort of, if you're starting to see in other, all in the north and East Anglia and everything, all coming up to sort of 5.5 times earnings, then might be seen as a little bit worse. And then yes, this you've got mortgage payments as a percentage of take-home pay. So normally the sort of rule of thumb would be around a third, sort of 30%, almost does seem to be the sort of longer term average, come down to sort of high teens in the 90s, which is sort of very, very cheap. That was why a lot of people got sort of fairly cheap homes, and then they rocketed up in price, so they've done quite well. But it's been up to sort of nearly 50% and sort of 45% in the housing bubble. And yeah, Q3 2021, we're only up to sort of 33, 34%. I guess this would have gone up slightly with the rise in interest rates this year, but not a huge amount. This may be a sort of mid to high 30s, I would guess. So we're not exactly at sort of top levels that we've seen before. So that's a little comforting. Again, they sort of split this out by region. Again, it's distorted by London a little. 55% sort of take-home pay in London, and sort of in the north, certainly sort of East Midlands, East Anglia, and then Scotland, Wales, and Northern Ireland are all under 30%, which isn't too bad, really. Assuming this is sort of Q3 2021, you sort of add probably a good few percent onto each of these for the rate rises this year, but we're not exactly motoring on with our rate rises. They're only up to 1.25%, so yeah, that's not too bad. And you just sort of see the house price to earnings over time, sort of back in 2001. Sort of there is a little bit of equality in this. It's has to be said. Sort of that used to be maybe 3 times a man of a couple's salary, and sort of not counting the ladies at all, expecting them to sort of have kids and stop working, and sort of over time that's pretty much changed, and you sort of got to 4.5 times and sort of 5 times or so. Not quite sure where they're suggesting this would go to 6.5 times in 2031. I think they're just sort of extrapolating this move and sort of expecting it to continue, but not quite sure why it would. So that's interesting, but if we got that, obviously it could push up prices if they're willing to lend that long. Maybe life expectancy, sort of expecting people to be taking 40 and 50-year mortgages. They might lend a little bit more, but yeah, we'll see. So some interesting UK stats. So looking a little more at the US side, you've got the sort of Fred economic data. They do provide an awful lot of data, more than you can get in the UK. So you got the median sale price of the US for sort of 60 years nearly, over 60 years. And this sort of broadly follows the UK, really, sort of in nominal terms. You don't really get particularly huge crashes, but sort of inflation adjusted, this would be worse. And yeah, obviously in the last couple of years, you've seen a tremendous rise upwards. So this could be a little bit vulnerable, but yeah, history would say you don't get a giant crash necessarily. Looking at housing inventory, active listing count, this only goes back 5-6 years, but yeah, tremendous sort of reduction in active listings. So sort of down to, even though it's risen up in the last sort of couple of months, up to sort of 516,000, you're looking at 1.5 million sort of 5 or 6 years ago. So that could be what is sort of keeping prices up, the lack of supply on the market. So looking at sale data, the new single family homes sold over time, this is sort of a little bit more up and down really, sort of for the last 60 years, moves up and down, sort of really a broad sort of long-term average of 600,000, and yeah, it moved up to sort of 1 million, over 1 million in the sort of housing bubble, even in sort of peaked in 2005, interestingly, and was sort of coming down well before the major issues. And then sort of, yeah, in the bottom, you're looking at sort of 300,000, even sort of up to 400,000 or 500,000 by 2015. And that is what we're pretty much down to now. So if you just sort of zoom in little bit more on the recent data, yeah, you peaked back up to 1 million again, but are now down to sort of 590,000 in April. Again, would expect this to sort of come down a little more in the next few months, but yeah, just looking at sort of previous data, wouldn't be crazy to sort of come down to 2015, 2016 levels. It'll probably make the news and be sort of called a disaster, but doesn't really seem all that bad. It's just compared to sort of the crazy peaks, really. I mean, we were at sort of 700,000 just before the pandemic. So yeah, that doesn't seem too bad. This is an interesting one. So this is the last 6 years of median days on the market for home listings. So this was sort of in the 80s and 90s, 70s, sort of in the 2017, 2018 time, sort of peaks up in sort of end of the year when people are less interested, and sort of springtime comes down to sort of lows every year because that's when people are looking to move. But I mean, basically, it's broadly trending downwards the whole time, and we're now at sort of, admittedly, springtime, so it would come back up, but 31 days compared to sort of, if you look at previous springs, 60, 57, 56, so now at 30. So that's fairly bullish, even if they're expensive. People are buying them anyway. So I think US mortgage rates is probably the biggest thing that people are flagging that's going to cause the crash. So sort of before the pandemic, 2015, 2016 levels, you were at sort of 3-4% for a 30-year mortgage. So this is very different for the UK people to what we do here. We don't have 30-year mortgages, but yeah, they sort of come down to obviously 3% or so with the rate cuts, but sort of very recently has been rocketing up, and now sort of 5.78%. I think this has gone to 6 on quite a few lenders. So yeah, 6% up from sort of 3 even less than a year ago is sort of making affordability quite a bit worse. But you do have to sort of zoom out a little bit and just see sort of the scale of how much this causes, really. So sort of previous rates have been, admittedly, this was a very short period of sort of double-digit rates, but yeah, they've basically been coming down sort of since the 80s. So you're getting 30-year rates of 10%, 7%, not uncommon. Sort of before the housing bubble, it was over 6%, and yeah, it's sort of basically been coming down since then. So whether we're into a new trend of sort of ever rising prices, if this is going to carry on, 7, 8, 9%, I'm not really sure. I think sort of things will break before then, and we'll be reducing rates and potentially sort of even printing money again before then. So yeah, we'll see what breaks first, basically. But yeah, on the long-term chart, this isn't exactly sort of a tremendous rise. So yeah, the mortgage payments as a So yeah, higher prices in the US and higher rates are sort of causing a little bit of an issue. Sort of mortgage payments as a percentage of household income is a bit higher than in the UK. This is going up to April 2022, and it's already up to sort of 38% nearly. This will have gone up with the May FOMC rate rise and the June one, and is projected to go up another 0.75% next month. So this could be getting towards sort of 20-year highs, which is a little bit of a concern. Sort of 41% in the sort of 2006-2007 bubble. Admittedly, the dot-com bubble wasn't sort of a huge housing issue, so it was never that high then. But yeah, you could get sort of prices come down as a result of this. People can't be spending sort of 55% of their money on their mortgage. Yeah, they sort of combine this into an affordability index of new homes in the US. So rate rises and prices have sort of brought this down to basically an all-time low of since the sort of late 60s. So that's a little bit of an issue. The household income covers 17% of a new home sale price. So they're only sort of being affordable because of sort of low interest rates over the last good few years, but now they are sort of coming up again. It is causing a little bit of an issue. So potentially, I still think we could be going back to sort of dropping earnings estimates. You might see tomorrow. We'll see what comes out of Lennar, but you could be eventually getting sort of 20%, 30% drop in these earnings estimates over time, maybe over the next sort of few months, and sort of it'll be up to whether people want to sort of stick at 4 or 5 price to earnings, and these would sort of come down to $50, maybe $45 if people get really sort of bearish. And sort of the UK guys, admittedly, they've got sort of net cash position, so it's not they're not in sort of solvency issues or anything. But again, these could come down, 20 or 30% off earnings, but depends what sentiment is going to be in sort of a housing crash, housing bear market. So yeah, I'm still sort of tempted. I might wait until tomorrow's Lennar results and just see what we've got. Looks like Barrett's coming down a fair bit. Taylor Wimpey sort of come down as well, 118 pence. But yeah, we'll see this week. Obviously, I'm looking at sort of various sectors, semiconductors and housing and miners and that sort of thing. But they've got to be long-term buys. I think we could see more downside, but we'll see. So leave your thoughts in comments below and like and subscribe. See you soon.